Hello, everyone. Welcome to session 6 of the massively open online course for the master's degree at the University of Nicosia. This is Andreas Antonopoulos. Today, we'll be talking about alternative uses of the blockchain, specifically asset registration, layer 2 protocol, smart contracts and property attestation, the Lightning Network, and a bunch of other applications that go with that. Joop asks, in the objective part, it says currency is the first, quote, app of this technology and definitely not the last. While I recognize that in the above quotes, the word app has been put in brackets, suggesting Bitcoin is not exactly an app, I feel it is a misrepresentation of the token that fuels the decentralization of the network. Is Bitcoin or another token an app, or is it an essential and integral part of a blockchain and the decentralized transfer of storage of entities of value or interest? Yep, that's very astute of you. I would agree with you. If you just take that on its face, really, the currency is not just an app. It's the first, but it's also an integral part, as you say, of the blockchain and the decentralized transfer and storage of entities of value or interest. In fact, it is also the native asset used to reward in the consensus algorithm, so it plays a role in the game theoretical security model that's implemented in a blockchain. Blockchains without native assets have not been demonstrated to any level of success and certainly cannot have an open consensus mechanism. So the currency is really not just an app. It is a very important fundamental part of the Bitcoin blockchain itself. But also, the pure role of that currency as a currency or as a payments network, that certainly is just one of the many applications that can be built based on a currency-fueled settlements and trust platform that is the much broader concept that is introduced by the Bitcoin blockchain. So you can read that two ways. It's not intended to be a scientific testament to the exact nature of how the blockchain works. It's intended to open the mind of the reader to the possibilities that exist above and beyond. Lucas asks, can you please expand on the definition of an oracle? Lucas, yes. An oracle is a third-party mechanism or automated system that produces signatures on Bitcoin transactions in order to attest to a fact that is external to the blockchain. This may involve a number of different things. A very simple signing oracle may, for example, enforce a policy for the spending of the transactions. It may say, yes, I agree this transaction. By signing this transaction, I agree that this user has set a desired level of spending that is less than the amount they're spending. So you enforce an external policy for putting an upper limit on how much money is spent every day, week, month, hour, whatever, or in a single transaction. You could have, for example, policies that say, I only want to spend to specific predefined whitelist addresses, in which case the oracle is attesting to that policy externally. So that's kind of a signing oracle where a third party is applying some policy. You could also have an oracle that is attesting to other things. They may be introducing data into the blockchain to attest to external stores of data. For example, checkpointing an alternative chain, saying what the price of an external commodity is, or index, or something like that. So an oracle really, in the broader sense, is a party that is participating in a transaction by signing to attest something external. Pedro asks, hey, Andreas, when issuing a colored coin, isn't the reasonable thing to do to color the value of one Satoshi only so that the value of the colored coin is effectively the value of the underlying asset? So yes, Pedro, there are a couple of different complexities that come into this. Ideally, you would want to color a single Satoshi only. However, there is a so-called dust limit in Bitcoin, which means that the minimum output you can create is 5,400 and something Satoshis. So you can't do transactions with outputs smaller than 5,400 Satoshis. Those are not considered valid by the network. So we can't actually color individual Satoshis at this time, at least. Pedro also asks, let's suppose that the value of an underlying asset is equivalent to 2 Bitcoin in value. How does the seller of the asset issue the colored Satoshi to the new owner at the same time the purchaser sends the 2 Bitcoins to the sender? Well, there are a number of ways you can do that. One way to do it, which is probably the easiest way to do it, is to create a transaction that has 2 inputs and 2 outputs, where the 2 inputs assign the colored Satoshi and the 2 Bitcoin, and the 2 outputs swap these atomically in a single transaction. Now, if I'm the buyer or the seller in this transaction, I know that I can sign it, and it will only be valid if both things happen simultaneously, and therefore I can sign it, and then the other person can sign it, and we know that neither party can spend half the transaction. Essentially, when you're signing a transaction with the Zcash all modifier, what you're saying is I'm signing, you can sign one part of the transaction to say I'm signing it only if all of the other parts of the transaction are exactly the same. That's known as an atomic swap. Atomic because it's indivisible, meaning that the transaction either happens or doesn't in whole, and swap because essentially you're exchanging a value within a single transaction. It's a very effective way to avoid counterparty risk in the exchange of funds on the Bitcoin network. And the second question is, how does the buyer know that the asset was not issued multiple times by the seller, or that the underlying asset is even real? Pedro, that is the really interesting question here, which is that when you have a colored coin that represents an underlying asset, and that underlying asset is not on the blockchain, is not native to the blockchain, which of course it isn't, how do you know it exists? This is called hypothecation. So a hypothecated asset is an asset that is in storage and for which a certificate is issued. And this certificate then is traded in lieu of the asset. That's how the gold markets work, for example. And so you presumably have a party that is storing gold. This gold is supposedly audited and should be audited by a third party to verify that it's actually there. And then certificates are issued that are traded. And theoretically, you can count the number of certificates that are on the open market and see that they correspond to the amount of gold that is hypothecated. That's just one example of a hypothecated asset that is traded as a certificate, and the certificate represents ownership in that asset. There is a problem with hypothecated assets, and that is that very often, when audits happen, or because of problems with auditors, or for a number of different reasons, the underlying asset isn't actually there. This is also one of the reasons that, as I said in the answer to my previous question, the native asset, the currency, is an essential part of the blockchain. One of the advantages that Bitcoin has with its blockchain is that the value that is being exchanged is native to the blockchain and is validated by the miners, and we know it's there. On the other hand, if what you were trading on the Bitcoin blockchain is just colored coins that represent other things, for example, stocks, bonds, certificates, etc., then you have the very real possibility that the underlying assets have been sold in different forms to multiple buyers, or that they don't actually exist, that what people think is stored as gold in the vaults is in fact tungsten that's painted yellow. Ioannis asks, In order to perform a colored coin transaction, do both the sender and the recipient need to have the same colored wallet, or are such transactions wallet independent? Yes and no. There are 2 or 3 different standards for colored coins, different implementations. And some wallets recognize one of those standards. Some wallets recognize more than one of those standards. And some recognize different standards from each other. So the sender and the recipient need to have a color wallet that identifies the same standard. One of the standards is called open assets, which is intended to be an open standard for colored coins, but which is not the first one that was designed, the first colored coin specification, which is implemented differently from open assets. And so depending on what kind of wallet you have, it may recognize different types of colored coins. So standardization actually is a bit of a problem in the colored coin space at the moment. Pedro said in a previous question that if a colored coin is sent to a normal wallet, the color will not be seen. Is it possible to find out that the extra data linked to such a transaction? And if such a transaction is sent back exactly as is the colored wallet, will the colored coins be visible again? Under certain circumstances, yes, you can maintain the chain of colored coins, even if you send it to a wallet that isn't aware. But again, that depends on the protocol implementation, and it can cause a lot of problems, especially if other parts of the transaction include other transfer of value. So the real danger is that if you send colored coin transactions are generally very, very small amounts, and if what you're coloring is a very small value of Bitcoin, which is the case with some of the colored coin implementations, that small value of Bitcoin very often happens to be perfect for including as a transaction fee, for rounding up to the amount you want to send. And so it's very likely that the regular wallet, the non-colored wallet, will take that small amount, use it as a fee to pay to round up a transaction to the value it wants to send, and send it off to yet another non-colored wallet that will swallow it. So at that point, it's been mixed and creates a chunk of UTXO. It's mixed with something else, and it's pretty much lost. Wim asks, can you clarify how tagging-based coloring algorithm works for colored coins? Maybe you can give an example to make the concept more concrete. Wim, usually, probably the best example, I think, is the Open Assets Protocol. And the Open Assets Protocol uses a first transaction, which is an issuance transaction, which has a number of outputs. One of those outputs is an op return output that then has a colored coin tag in the data part of op return that identifies what asset is being issued, how many of these assets will exist, and various other specifications. And you can easily find the open asset specification to see what that issuance transaction looks like. And then you can then create outputs which, again, have op return to identify what output is being created, followed by value outputs that can be transferred from wallet to wallet, which, based on reading the tag that comes in the op return, you can tell what kind of colored coin that is, which asset it corresponds to. It has essentially a number of the asset, and then you can assign it, so that essentially you've tagged and said, OK, the following 2 outputs are of type pork belly, and pork belly is the asset that's being tracked. And then you can look on the blockchain to see when pork belly was issued, how many pork belly were issued, and pull up more information. Some colored coins specifications use an external data set, for example, a link to a database that's outside of the blockchain. Others expect all of the asset information to be in the blockchain itself, more limited information, of course. So it depends on how it works exactly. When you want to send a colored coin to someone else, how do you add the transaction fee, as these will be needed in uncolored coins? I do read in the course there is multicolor support for a colored coin transaction, so the fee, I assume, will be included there. Yes, essentially, Job, if you're using a colored coin wallet, it also has a Bitcoin wallet, and the Bitcoin wallet is used to pay the fees. So you also put some amount of Bitcoin in there, and that's used to do Bitcoin transactions. It can do Bitcoin and colored coin transactions. I think most, if not all, colored coin wallets can do Bitcoin, just regular Bitcoin transactions, and they can also do colored coins. Let's see. Jerome asks, what is the difference between sidechains and Lightning Network? Okay, this is a really good question, and this will take a while to explain. So let me take a deep breath and a sip of tea. So sidechains. Sidechains are implementation of an alternative blockchain in parallel. And you may have two blockchains that are linked through this sidechain functionality. Any two. It could be Bitcoin and Ethereum. It could be Ethereum and Litecoin. It could be Litecoin and Dash, or whatever. And you could have multiple links between multiple chains that are connected to each other. Essentially, when you have a sidechain, you have a special type of function that is called a two-way peg, which is implemented in both of the chains, that allows you to do the following. It allows you to address UTXO, unspent transaction output, from one chain in the other chain. So here's an example. Let's say I have a Bitcoin to Ethereum sidechain. I would need a way to lock Bitcoin, some value of Bitcoin. And instead of locking it to an address, I lock it to the sidechain. And I say, I am making this Bitcoin available to the sidechain. And at that point, you have a corresponding transaction in, let's say, the Ethereum sidechain that says, by reference to this transaction second output here, where Bitcoin was locked to the Ethereum sidechain, I'm going to release some Ethereum to this recipient. And so essentially, you've transferred it. It's almost like opening a wormhole or a tunnel in the output of one Bitcoin transaction, where the other end is an input in the Ethereum chain as an input into Ethereum transaction. And then vice versa. On the Ethereum side, you say, well, now I'm going to take 2 Ether, and I'm going to switch it back to Bitcoin. And that allows you to then create a corresponding transaction in the Bitcoin side that says, with regard to this Ether that I locked up, I'd like to now release some Bitcoin. So sidechains allow you essentially to move currencies from one blockchain to another using a two-way peg mechanism, where essentially they're locked into a relative price between the two at the moment of transfer. Lightning Network, on the other hand, isn't another chain. Lightning Network is the exchange of transactions between parties that don't actually publish these transactions. So it's like keeping a bar tab or a personal record of a series of transactions. So let's say I wanted to transact 10 Bitcoin with some other party, and we're going to do a lot of back and forth transactions, but we know it's never going to be more than 10 Bitcoin. So let's say we both lock 5 Bitcoin each into a multi-signature that we both control. And so I put in 5 Bitcoin, and Alice puts in 5 Bitcoin. And now we put that into a multi-sig in Bitcoin. We control, I control one key, Alice controls the other key. And now let's say I want to send, because I'm not sending really. I'm basically committing. I'm promising. Let's say I want to promise Alice 1 Bitcoin. So what I really want to do is say, we still have 10 total, but now 6 of them are Alice's and 4 of them are mine, because I want to change the ownership of that one. So we both sign a transaction. that gives a 6 Bitcoin refund to Alice and a 4 Bitcoin refund to me from the multisig. But we date it 30 days into the future. And now we say, OK, great. So now we know that if at any point in time we just stop talking to each other, we can take this transaction. Either one of us can take this transaction, can deposit it essentially on the Bitcoin network and cash in this transaction. It's like writing a post-dated check, but we won't. Instead, we'll just hold it. We're not going to broadcast it. The only thing that's being broadcast on the Bitcoin network is the original multisig that we created with the value. Now, maybe a minute passes by, 10 minutes pass by, and we say, hey, hang on a second, we want to do another transaction. Now I want to give Alice another Bitcoin, so I want to update. And instead, I want the final balance to be 7 and 3. Great. OK, so in order to do that, we write a new transaction. And this new transaction pays Alice 7 and me 3 from the same multisig, double spending the same amount that we wrote in the previous transaction, the same UTXO. And then we date that to be a day before the previous one, essentially canceling the previous one. Now, if I broadcast the 7-3 split first, it will spend the UTXO, and then the 6-4 transaction essentially is irrelevant because the UTXO that it depends on has already been spent. So now we essentially change the balance. And through mechanisms like that, including a function called a hash time-locked contract, the check lock time verify primitive, and multisig, we can create these complex bidirectional channels. Lightning Network takes this a step further, where it says, OK, if I want to pay Charlie, and Charlie owes money to Alice, and Alice owes money to me, instead of paying Charlie, what I do is I let Alice off the hook for some of her debt, and she lets Charlie off the hook for some of her debt, which effectively means that Charlie got paid from me. But we did it with 2 payment channels. I paid Alice, or rather, Alice paid me. And sorry, I paid Alice by letting her off the hook for some of her debt, and then she paid Charlie. And through that transition, Charlie got paid by me. And now imagine this with 20 links or 30 links between people. And essentially, you're making a promise to pay the next person if they pay the person after, if they pay the person after that. And that promise doesn't really take effect until you reach the end. And then the last person gets paid, which means that the person before the last got paid, which means that the person before the last got paid, and the whole chain unravels backwards. It's a really neat idea. Now, in all of this Lightning Network, in the bidirectional payment channels, we're exchanging these signed Bitcoin transactions like post-dated checks, but we're never actually telling anyone. We're just keeping them. We're just storing them on our own systems, and knowing that we can cache them at any point in time in order to anchor the transaction, or we can just leave the channel open by not caching them and continuously updating by creating new ones and revoking the old ones. So this is very different, right? Sidechains are 2 parallel blockchains with multiple people being able to move money between the chains. And Lightning Network is like this layer above of these, let's say, Bitcoin transactions that are flying around between people that represent promises that are never cached, and allow us to keep a running balance between 2 parties, and by extension, between multiple parties. Frederick asks, what is a drive chain versus a sidechain? In really simple terms, Drivechain is a sidechain. It's just a different implementation of a sidechain. Sidechain, as described today, is based on a design that was proposed in a white paper. And Drivechain is a design for a sidechain using a different set of functions in the 2 chains, but which implements exactly the same idea. It's a 2-way peg between 2 chains. It's named Drivechain just to distinguish it from the sidechain implementation. It's an alternative way of implementing a sidechain. Is segregated witness or other technology needed to implement sidechain Drivechain? I'm thinking of transaction malleability. Yes. Segregated witness is needed for two reasons. One, because of transaction malleability, and the other one is because segregated witness makes it a lot easier to introduce new script operands, new script language into the system. So before the introduction of SegWit, you've got to understand that we have a specific set of 256 operands. I believe it's 256. Anyway, a limited set of script operations. So for example, op0, op2, op check multisig verify, op add, op multiply. Some of those are disabled. Some of those have never been enabled at all. Some got disabled at some point because of denial of service attacks. Some have been redefined. There's a bunch of unused ones. I think there's only 12 left now. I'm going to say 12, but I'm not entirely sure. There's a bunch of unused ones, which can be redefined with a soft fork. That's how check lock time verify was introduced. It redefined the meaning of one of the nop. Nop means no operation. And these were the unused, undefined codes that were left for future compatibility. Here's the problem. We're running out of those. And there is no easy way to upgrade the scripting language because there's no versioning in the scripts before SegWit. And also, you can do some complicated, hairy things where you can say, if you see op nop 12, that doesn't mean nop anymore. It means op extended script, and then it's followed by another operator that gives us another 256. So now you use 2 bytes to define it, which is kind of a bit of a kludgy hack. SegWit is a different way of doing it. SegWit has script versioning. So you can redefine the entire semantics of the scripting language by simply choosing a new version. And that means adding, effectively, an unlimited number of script operands. So because sidechain, drivechain needs some new language primitives within the scripting language, SegWit is the easiest way to introduce those. So I will qualify that I think it might be possible to implement sidechains without SegWit. It might be possible. I don't think it's a very good idea. I think it would be very difficult and complicated to do it without SegWit. But it might be possible. In any case, I think we're going to see SegWit in the next 3 months. Is the block size an issue for the implementation of sidechains or other uses of the blockchain, asks Frederick. Great question. It's both an issue and a solution. Yes, the block size constrains what you can do, which means that every transaction you do to move money to another chain has to be paid for, and that's going to take up capacity. But at the same time, the interesting thing is that the implementation of sidechains allows you to move capacity off the blockchain, off the Bitcoin blockchain, perhaps, to another blockchain that's doing something else. And not doing the transactions natively on the Bitcoin blockchain. So you could say, OK, one transaction to move, and we're going to do a whole bunch of transactions over here, whatever they may be. Maybe it's a higher capacity Bitcoin that you've created, or something else. And then move back when we're done, if we're done at some point. And that allows you to essentially shift the capacity to the other chain. But again, probably not a very good solution for optimization. Jan van Dort asks, can someone explain to me the relation between a smart contract and the Mastercoin protocol? I can try, Jan, but it's going to be difficult because nobody knows what the hell the word smart contract mean. Everybody uses the word in a different way. Everybody uses these to say that whatever they're building is a smart contract. What's a smart contract? It's a dumb program. A smart contract is essentially a combination of conditions or in some cases, functions that implement some kind of constraint on the use of funds. You could say that, broadly speaking, I guess. That would be one definition. Otherwise, it's kind of meaningless. A smart contract is just a software program. So, is multisig a smart contract? I would argue that it is. It places conditions on funds in a way that is relatively complex. Lightning Network bidirectional payment channels are built using smart contracts that are written in the language of the Bitcoin scripting system. They're not as complex or flexible as, say, an Ethereum smart contract written in Solidity, but they're still smart contracts. Mastercoin is a second-layer protocol, and that second-layer protocol implements a number of interesting functions, which I would consider probably to be smart contracts, yes. And you have assets, you have exchanges, you have a number of other functions implemented in Mastercoin. The difference between a Bitcoin smart contract, such as the one used in Lightning Network, and Mastercoin smart contract is that the Bitcoin smart contract is evaluated by the consensus rules of the chain. The same thing with Ethereum. An Ethereum smart contract is evaluated by everyone by the consensus rules of the chain. The Mastercoin protocol is not evaluated for consensus by everyone who's on the Bitcoin blockchain. Essentially, it's invisible to the miners of the Bitcoin blockchain. It's only evaluated by the participants of the Mastercoin network. And that's one of the difficult choices or trade-offs, design trade-offs, between building your own chain or building a layer above Bitcoin that offers additional functionality but is outside of the consensus validation rules. Frederick asks, what is Mimblewimble, and how could this be implemented as a sidechain? Frederick, that's a great question. I'm going to do my best to explain this. I think there's probably only about 10 people in the world who really understand what the hell Mimblewimble is and how it works. I watched the presentation recently. If you're interested, look at the Scaling Bitcoin conference. And Andrew Polstra did a really good job of describing and explaining Mimblewimble. And I think maybe now, instead of only 10 people knowing what it is, I think 100 people think they know what it is, but still only 10 actually know what it is. Mimblewimble is a design for a different type of blockchain that uses certain properties of elliptic curve, specifically the ability to aggregate signatures and to aggregate elliptic curve points, in order to do this kind of very radical pruning and summarization of both signatures and transactions within a blockchain, very minimizing, aggressively minimizing the size of the chain or the stored data that you have to store for the blockchain in order to do validation. It also combines something that looks very similar to confidential transactions, so you can't really see the values. The senders and recipients, if you like, or the inputs and outputs are elliptic curve points, but those can be aggregated and summarized in such a way that you can't really tell who's participating in a transaction. So it's kind of radical coin join plus radical confidential transactions plus radical pruning with aggregation of elliptic curve points. And the way Mimblewimble does that is by making the structure of inputs and outputs very simple. They're no longer fully configurable scripts as they are in Bitcoin. Instead, they are simply elliptic curve points. And that means that they can be manipulated using elliptic curve mathematics to do some very interesting things. Mimblewimble can be a very high capacity, very scalable, extremely scalable, and extremely private type of blockchain. And could this be implemented as a sidechain? Yes, and I think that's really one of the interesting possibilities here of using Mimblewimble to do a sidechain that has very high capacity as well as very high levels of fungibility and privacy. in parallel to Bitcoin. Okay, let's see what else we have here. I skipped 1 or 2 questions earlier. All right, so this is slightly off topic, but I'll go for it anyway. Michael asks, is it realistic that Bitcoin Unlimited will be able to stop segregated witness activation, since Core needs 95% acceptance of SegWit, and Bitcoin Unlimited has around 10%? First of all, I don't think it's Core that needs 95% acceptance of SegWit. SegWit needs 95% acceptance by miners over a rolling period that lasts, if I'm not mistaken, once activation has started. If at any moment over a period of 2 weeks, the rolling average level of hashing of the last 1,000 blocks reaches above 95%, it's activated. So is it realistic that Bitcoin Unlimited can stop it? I don't know if it's Bitcoin Unlimited is actually saying this. I think it's actually a few others. So via BTC, which is a new pool that is backed by some other miners and pools. There's a lot of drama going on. Anyway, I won't qualify the drama with any attention. But what I'll say is that there are some parties who have approximately 10% of the hashing power right now, and say they are going to commit that hashing power to stopping acceptance of SegWit, kind of like a veto. They would need to maintain 10% of the hashing power without any possible loss for the entire activation period of SegWit. And that could be difficult. It could be difficult to maintain that hash rate. On the other hand, if the people who are very interested in acceptance of SegWit could conceivably turn on more hash power that they have, perhaps with slightly obsolete machine, and just tip the balance by 5% and get SegWit activated. They only need to do it once. So this isn't the kind of election where you have a specific moment in time, and if at that moment it's yes or no, then it passes or doesn't pass. This is a system where you have the accumulation of votes, and if at any point in time during the 2-week period there are 950 of the past 1,000 blocks on a rolling count that indicate acceptance of SegWit, then that's it. You got to keep in mind that part of this is going to play to randomness. All it would take is for the veto people to have a particularly bad luck stretch of 10 blocks in a row, and it could tip over the activation just because by sheer luck they didn't find blocks during a period of time. All right, let's see. Some questions about Zcash that I may or may not be able to answer. Zcash is still very new. I've read the papers and I've ran the software, but I'm not entirely sure I'll be able to answer them. How could double spending and no notification of previous transactions be detected in Zcash if something goes wrong? Asks Pedro. Great questions, Pedro. Thank you. Well, because of the form of homomorphic encryption used in Zcash, which is called the ZK snark, you can detect double spends, and you can also detect if the inputs and outputs are not balanced, even though you don't know what the inputs and outputs are. So that is the premise of homomorphic encryption. Second question from Pedro. Can a completely fungible cryptocurrency like Zcash be simultaneously transparent and traceable? I don't know what you mean by traceable. So you can publish. So let me see if I can try this. Can it be transparent? I believe that if you want, with Zcash, you can publish proofs that show, that kind of reveal the transaction. So you can, if you are the sender of a transaction, prove that a transaction happened, and prove the amounts within that transaction. But I'm not entirely sure. So you can, I think, introduce transparency as an option. So then the second part of your question is, do Bitcoin developers want it to be fungible? Yes, they do. How do I know that? Pretty much the entire scaling conference was about privacy and fungibility. So we saw a clear indication by the developers, and that represented a good 75% of the entire developer community in Bitcoin. And fungibility was a huge topic. And if yes, could the Zero Cash protocol functionalities related to fungibility be implemented within the Bitcoin protocol to solve the fungibility issue? Or is it not open source / proprietary? There are many ways that Zcash could be used to increase fungibility in Bitcoin. You could use Zcash as a sidechain. You could implement ZK snarks. They're not proprietary. They are open source. You could implement ZK snarks in the Bitcoin protocol. You can use something similar, which may be a tiny bit more efficient, even though it might not be quite as strong as ZK snarks, which is the proposal by Greg Maxwell to do confidential transactions. So there's a very similar type of homomorphic encryption mechanism used in confidential transactions. There are a number of ways. So yes, we will probably see an impact from the implementation and inventions behind Zcash. We're probably going to see an impact on the fungibility of Bitcoin over a longer term, with some of those features being implemented in Bitcoin. Apart from the percentage of the mining fees in the first 4 years of existence, which are to be given to private investors and employees who funded and developed Zcash, is Zcash as public decentralized blockchain and open source as the Bitcoin blockchain? As far as I know, yes. So it's a public open source protocol. Part of the consensus rules are to compensate the private investors and developers. But the consensus protocol, the software itself, is all open source. I've downloaded it, compiled it, and ran it. It's a public decentralized blockchain. It's open access, open participation, and the source code is all there. Kieran asks, when Bitcoin are sent from sender A to recipient B, then B receives the Bitcoin in a matter of seconds. However, in reality, the transaction is confirmed after 10 minutes approximately. Isn't this delay a flaw which someone can exploit? Shouldn't the balance of B reflect the newly received Bitcoins after it is fully confirmed? Can someone please explain? Thanks in advance. Kieran, I think it is better if we change the words we use here. Bitcoin is not a system that transmits. There is no sending and receiving. We use those words really to simplify the concept. It's not as if Bitcoin leaves one address and then travels somehow over the blockchain and then arrives at another address. A transaction is created. That transaction, in a single function, and instantaneously, once that transaction is seen by everyone, that transaction has the effect of reducing the balance of one address or sender consuming some value of Bitcoin, and at the same time, in the same transaction, increasing the balance of the recipient. So that transaction happens atomically, meaning that there is no sending and receiving of Bitcoin. There is a sending of a transaction that must be received by everyone. But either you have seen the transaction, in which case the Bitcoin is now belongs to B, or you haven't, in which case it still belongs to A. But there is no in between. There is no, it no longer belongs to A, but it hasn't yet been added to B, because those two things happen simultaneously. Confirmation is really clearing. It's not the transmission. So the transaction gets transmitted across the network. As more and more nodes see that transaction, they become aware that B now has this value and A no longer has this value, and they find out these two facts simultaneously. Now, once everybody's seen that transaction, which takes a matter of seconds, everyone now knows that B's balance is higher and A's balance is lower by that amount. 10 minutes later, that transaction is mined into a block. Now, what can happen during those 10 minutes? What can happen during those 10 minutes is that if there is a fork in the network, and during that fork, that transaction is double spent, or for some reason it is not deemed invalid by the other fork, then effectively the balance of B will not reflect that transaction after the fork converges again. So the wallet may choose to reflect the balance when it's confirmed, or it may choose to reflect the balance as soon as it sees the transaction, assuming that it will be eventually confirmed. That's really a choice of the implementation of the wallet. If B decides to use the fact that they have a balance to, for example, ship a product before there's a confirmation, or hand A a product, they run a small risk that that transaction will be double spent or reversed effectively within the next 10 minutes. After 10 minutes, once it's confirmed, that chance is reduced dramatically. After 20 minutes, it's reduced even more, and it exponentially goes down until as the number of confirmations keep increasing. And there's never kind of a limit. We say after 6 confirmation, it's done, simply because at that point, the risk of reversal becomes infinitesimally small. But really, I have transactions that have 200,000 confirmations because they were conducted 4 years ago. And those transactions now have 200,000 blocks on top, so they have 200,000 confirmations. You could estimate what that means. So again, when Bitcoin is sent from sender A to recipient B, and B then receives the Bitcoin, that's not how it works. The Bitcoin happens immediately in the same transaction. Sender A's balance goes down, recipient B's balance goes up, and you either see that transaction and know both facts simultaneously, or you don't. Bandelis asks, I've been reading your book, specifically the section labeled Consensus Attacks. I understand how mining pools that concentrate a large percentage of the total hashing power can use their position to mount 51% attacks in order to introduce double spends. My question is whether a denial of service attack against non-mining Bitcoin nodes can help make such attacks easier, even for pools that don't own a large share of the total hashing power. Yes and no. So a distributed denial of service attack can help deny service to certain users by effectively making it difficult to propagate transaction. It's very difficult to do that. A distributed denial of service attack could also be used against miners to stop them from being able to mine effectively. A distributed denial of service attack could be used against pools. And we've seen that happen. We've seen all of the above happen. And it can disrupt mining pools, thereby dropping the total hashing power that is effectively participating and making it easier to attack. Usually, these attacks can't last very long. And pools have ways of moving to different addresses, or taking certain countermeasures to stop a denial of service attack. And we haven't seen it coincide with a 51% attack. But certainly, denial of service simultaneously to a consensus attack would make sense. It would be a mechanism to make the consensus attack easier. All right, let's see if we have any live questions from the audience. I don't believe we have any further follow-up live questions. Let's give it just a few seconds. So we're waiting for live questions from the students. Anyone who's participating in this live session, you can ask questions using the built-in YouTube comment function for this live Hangout. Otherwise, of course, you can always ask questions in the forums, which we will handle next week. And sometimes we also add a few of the previous week's questions if they haven't been sufficiently answered. So here comes a question. Could you disrupt the network by putting a lot of invalid transactions in the mining pool? I'm probably going to assume you meant in the memory pool, which is essentially the pool for transactions that have not been confirmed yet. You can't really disrupt the network by putting a lot of invalid transactions in the memory pool, because you will not get your transactions propagated. So let's say you created an invalid transaction or 1,000 invalid transactions. You connect to a node, any node, and you say, here's a new transaction. They attempt to validate it. They find that it is invalid, and they drop it. So they won't send it to anybody else if they themselves do not validate it first. The only transactions that are propagated across the network are validated transactions. Every node, whether they're mining or not, every node that is participating in the network, propagation network, validates according to the consensus rules before forwarding that transaction to other peers on the network. So essentially, you won't get very far. You'd have to keep connecting to new nodes, telling them about this transaction, at which point they'd ignore you and they drop it. You wouldn't get your transaction into a single node's mempool because all of them would reject it and not forward it. Could you send a lot of transactions that have very low fee to a lot of different nodes in order to fill up the mempool? Yes, you can. And in fact, we've seen that kind of attack. And that's why a lot of the nodes will stop accepting transactions which have very low fee. Either they won't accept transactions at all below a certain fee, and they won't propagate them, or they'll accept them, but only if the mempool is empty. And if the mempool isn't empty, they're going to reject those transactions. So there are built-in mechanisms to protect against denial of service. And part of the reason for that is because denial of service attacks keep happening. And the more attacks happen, the more the network develops countermeasures and immunity against those attacks. So the reason the Bitcoin network is in service is not because it has not been exposed to denial of service, but because it has been exposed to denial of service continuously for 7 years. And it has managed to thwart these attacks and get stronger with every attack by learning a new attack pattern and becoming immune against that new attack pattern, to the point where you can't even really slow down the Bitcoin network nowadays. And I believe that was the last question we had from our live audience. This has been session 6 of the 6th iteration of the Massively Open online course for the master's degree for digital currencies by the University of Nicosia. I'm Andreas Antonopoulos, and I'll be seeing you soon. Thank you so much for participating, and thank you all for the great questions this session. Take care. Bye-bye.